day. I'm Vanessa Mokem from Regan van Roy, here to talk to you today about a recent article titled "The PE or Not PE? Answer may surprise you." Generally, companies try really hard to avoid a permanent establishment, which we refer to as a PE. However, in some cases, it may be better to actually create a PE, particularly where a country levies a high services withholding tax. So what is a PE? A PE is basically a taxable branch which a company has in another country as a result of business activities conducted in that foreign country. For a PE to exist, normally a company usually has to have a presence in the other country for at least 6 months, although the trigger can be shorter in some countries. So why don't we want a PE? When a company creates a PE in a country, that country would be allowed to tax the profits that are earned in that country as a result of that PE. However, the company will also be taxed on its same income in their country of residence, where they would normally be taxed on worldwide income. The double tax may arise. Where a presence is unavoidable in a country, it is rather normally recommended by tax advisors for that company to create a formal subsidiary in that country. So why would it ever be better to create a PE? The short answer is withholding taxes. African countries in particular love withholding taxes, and their favorite withholding tax is on service fees. And even where there is a DTA in place that essentially prohibits withholding tax on service fees, the African countries still like to apply them. So although in most cases where there is no PE, there should be no services withholding tax, many African countries still levy the services withholding tax. It is important to remember that a withholding tax is levied on the gross amount of profits, whereas income tax or corporate tax is levied on the net profit. Let's consider an example. The company earns income from services rendered to a foreign country of 100. That country levies, for example, a 20% service withholding tax, and therefore a tax of 20 is payable in that foreign country. In contrast, where you have a PE, corporate tax of 30% will be payable. Assuming a profit margin of 25%, we will get profit of 25. A profit of 25 multiplied by the 30% corporate tax rate gives you tax of 7.5. Clearly, a tax of 7.5 is much less than a tax of 20. So what should companies do? The short answer, as always in international tax, is it depends. Companies should definitely consider whether they create a PE or are at risk of creating a PE in a foreign country. And if they do, what are the implications of that? Where high services withholding tax is levied, creating a PE may actually be cheaper from a tax perspective than not having a PE. Of course, administrative costs in the foreign country should also be taken into account. So if you are at risk of creating a PE or you're concerned about creating a PE, please do contact us and we can consider the most tax efficient option for your business. Thank you. Bye.